Hello, everybody. Welcome to our presentation tonight. We're so happy you can join us. We hope the next one, this was originally going to be in person at a restaurant. And as COVID and Delta became apparent over the summer, we brought back to this virtual event. I hope you enjoy it. We've got a great presentation. On the call tonight, before we get started, in addition to myself, we have Mary Harris, our marketing guru. Mary, thank you for setting this up tonight. Denise Colleran, our compliance customer service director, always a friendly voice on the phone, and Mary Kay McCourt, our office manager, general go-to person, and my lovely wife, for those of you who don't know. Lastly, we have our advisors, myself, Dan Song, and Tim Nguyen. We'll all be here at the end of the call should you have any questions. I'm hoping most of the questions you have are for our expert, who I'll introduce in a minute. Tonight's topic is commercial real estate and why it is part of your portfolio. We find this topic especially interesting given how things changed with our world, grappling with the infectiousness of COVID and subsequent virtualization of work. Plus, the historic plunge in the markets in early 2020 caused us to re-examine our real estate exposure. But with some research, we decided at that time to stick with real estate in your portfolios. Tonight, we have an expert for you that does a terrific job explaining why investing in real estate still makes sense in our COVID virtual working world. Evan Certain, did I pronounce your last name correctly?
Certain.
Evan Certain is Senior Vice President in the Portfolio Specialist Group at Cohen Steers, an institutional money manager with a very long history specializing in real estate investing. Well, he doesn't look it. He has almost a quarter century of experience, 15 years with Cohen Steers. His prior experience was as a portfolio specialist with Deutsche Bank and as a research associate at Bank of America. He's also a BA from Brown and MBA from Fordham. So with that, Evan, you are up.
Mark, thank you very much for the introduction, for the invitation to speak today. I'm going to share my screen and review the presentation that we've prepared for today. Mark, can I confirm that you can see that?
Yes, looks good.
Okay, good. Well, thanks again for the opportunity to speak here. I should introduce just briefly Cohen & Steers, and you can see on the screen we've got just some data about ourselves. We were founded in 1986 as the very first investment manager to specialize in listed real estate investments. And so we were the first company to create portfolios of REITs, and those portfolios exist now in mutual fund form. Our flagship Realty Shares Fund just celebrated its 30th anniversary. So we have the longest tenured real estate mutual fund in the industry. And I do want to just define what we mean by REIT for those of you who may not be fully aware. A REIT is a real estate investment trust, REIT. And it is a publicly traded company that owns and operates commercial real estate and collects rents from the tenants of those real estate properties and pays out the bulk of its net income to shareholders in the form of dividends. And by law, any company that is a REIT is going to pay out at least 90% of its net income to shareholders in the form of dividends. In exchange for doing that, these REIT companies have an exemption from corporate income tax. So it is a very tax efficient way for individual investors to have an allocation to commercial real estate. And so the yields on these securities tend to be above average. And the total returns compared to the broad equity markets have been very competitive over long periods of time. So One of the most, in fact, I'm going to skip a few slides because the most important slide in this deck is a few slides down, and this is it. For those of you who may not be watching the REIT market day to day, this is probably the most instructive slide that we have here. And what we've done on the left-hand side is to compare the REIT market of 2 decades ago with the REIT market of today. And in addition to just being so much larger in size in terms of market capitalization, significant increases in market capitalization over the last 20 years. Really, the most important thing to understand about the US REIT market is the change in composition. For most US REITs, if not all US REITs, they really specialize in a particular property type. So you have REITs that are that own and operate apartment buildings, and REITs that own and operate data center companies, and REITs that own and operate office buildings. And they tend to specialize in a single property type. And when you look at the REIT market of 2 decades ago, most of that market 2 decades ago, as you can see, that's 65% there, were in what we call traditional real estate property types. And we've defined traditional on the right-hand column here. Things like apartments, things like office, things like other kinds of retail property types. But you fast forward 20 years, and what you see is that the proportion of the REIT market that consists of those traditional sectors is a lot smaller. And what has taken over in dominance in the US REIT market are some of the property types we've identified as alternative sectors. These would be things like cell tower REITs and data center REITs, and as you can see, healthcare and self-storage. And so the composition of the market has changed significantly, and we've seen new sectors emerge in investable REIT form, things like cell towers and data centers. They may not be household names or things that many people think of when they think of commercial real estate or even investing in commercial real estate, but they are very significant parts of our market. And just to give you a real world example, when you pick up your smartphone and you buy something on Amazon, you are engaging in some of the largest REIT property types that exist right now. So when you pick up that cell phone, you buy something on Amazon, first of all, you are engaging with a cell tower that is very likely owned by a REIT just to get the signal on your phone. When you place that order, Amazon or the e-commerce company that you're doing business with is going to route that order through a data center. And there are REITs, as you can see here, that specialize in owning and operating data center properties. And ultimately, before that package arrives at your door, it comes from somewhere. And that somewhere is a warehouse and logistics facility that very often are owned by REITs in the industrial sector. So right there, you've got cell towers, you've got data centers, you've got industrial. Those are the 3 largest individual sectors currently in the US REIT market. So just by doing that simple transaction, which is obviously so commonplace these days, you yourself are engaging in the kinds of properties that REITs own and the kinds of companies that we own in our portfolios. But I'm gonna skip back to toward the beginning of the deck just to give you a sense of the kinds of things that we are looking at from a macroeconomic standpoint. 2020 was a very challenging year for our asset class, the US REIT market. And especially when you compare the performance of the US REIT market to the broad S&P 500 index. Last year, REITs were down in 2020 around 5%. And while the S&P 500 was up around 16%. So we saw very material underperformance given the challenges around certain kinds of real estate. But of course, we've got vaccine distributions. We've gotten significant fiscal and monetary support from the US government. And all of that has helped us move into a new economic regime. And we do believe that the early stage of an economic recovery, the kind of stage that we continue to believe that we are in right now, I should say, has historically been very supportive of REIT share prices. And that, of course, has to do with one, as economic growth returns to health, you've naturally got more demand for all kinds of commercial real estate properties. But that monetary policy that typically remains very accommodative in early stages of a recovery is also very beneficial to REIT share prices. We've heard a lot at the same time about the potential for rising prices, and we've seen evidence of that already. And we've gotten a lot of questions about the effect of inflation on our asset class. And there are certain characteristics about our asset class that we believe lend itself well to serving as a hedge against rising prices. We have some data a few slides from now that I'll show you when we get there. And then, just the general investment themes, some of which I touched on just, in my real world example about ordering something online with your phone. We've seen a profound secular growth in demand, even before COVID, for things like data center properties and cell tower properties. When you consider all the increase in cloud computing that is part of our personal and professional life, when you consider the introduction of 5G wireless standards, all of that accrues to the benefit of the owners of data center properties and cell tower properties. And even from a demographic perspective, let alone a technological perspective, we're seeing greater demand for senior housing facilities. There are REITs that specialize in those kinds of properties. We do think there's a demographic tailwind there when you consider the aging of the baby boom generation and the ways in which that cohort will, over the next decade, seek out those kinds of facilities. And then there are newer REIT property types, really only 10 or 15 years old, things like single family for rent REITs. These are REITs that specialize in renting freestanding homes. And the challenge in the for sale housing market, the lack of overall supply to meet demand, and the challenges of aging millennials as they start to have families now and are burdened with more student debt than ever before, and therefore have a hard time putting down a down payment on a home, make them renters out of necessity. And we've seen REITs emerge that are leveraged to that kind of demand. So there are lots of investment themes that we're reflecting in our portfolios right now. In terms of economic growth, there are some pent-up forces, and you can see some of this on the current slide here. Things like personal savings as a percent of disposable income. That has increased substantially since the pandemic. And while we have seen gains in employment since early last year, we are still millions of jobs short of where we were at the peak prior to the pandemic. So there still are some pent-up forces that we believe have yet to be fully unleashed, and that will continue as they become unleashed to be supportive of demand for commercial real estate. And what does that mean for the companies that we're investing in? That, of course, is the ultimate question. What we've got here are some estimates for both cash flows and for dividends over the next few years for the US REIT market. As you can see, 2020 was a very challenging environment, both for cash flows and for dividends. We saw declines in both in 2020. However, this new economic regime that we've entered, combined with the fiscal and monetary policy support, is all pointing to a resumption of both cash flow and dividend growth for the companies in our market both this year and over the next several years. And I do want to make the point about inflation that I alluded to earlier. You can see on the right-hand side of this slide some of the natural characteristics of commercial real estate landlords that make them relatively attractive in periods of rising prices. Commercial real estate landlords, like the ones we are investing in our portfolios, tend to have high operating margins, and so do have a bit of a cushion relative to companies in other parts of the economy to absorb generally rising prices. Although for most commercial real estate landlords, and especially the ones that we are investing in, there's pretty low sensitivity to rises in commodity prices. What you also have is the fact that for real estate developers, it's really for the real estate developers where you have the greatest burden, because as prices rise, the cost of materials, the cost of labor, all increase. And that puts a burden on the developers as opposed to the landlords themselves. And of course, in this portfolio, we are focused on the landlords. So what rising prices ultimately do is put a cap on new supply. When you are a real estate landlord, the last thing you want is for new supply, or what is really new competition, to enter your market. So rising prices tend to have a negative effect on development. And if you're a landlord, that's a good thing. If you look at the left-hand chart that we've included here, we've plotted the growth. There are two lines here, as you can see. That darker blue line is what's listed here as NOI, or net operating income. That's the income that REITs have generated over the last 25 years or so. And we've plotted that growth against that lighter blue line, which is just the general growth in CPI, or inflation generally. And as you can see, over the last 25 years, the growth of REIT income has mostly exceeded the growth in CPI. So we do think that there is ample evidence to point to demonstrate REITs' ability to act as an effective inflation hedge. And there are lots of property types, as you can see, available to us in REIT form to invest in. And the point of showing you this scatter plot here is to demonstrate that there's a very wide sensitivity, economic sensitivity, across all of those property types. And there's also a very wide spectrum of lease durations. How long are the leases that these real estate landlords have with their tenants? As you can see, there are property types where the lease durations tend to be pretty short. Hotels is the classic example. The lease durations for hotels can be as short as 24 hours. For apartments, it tends to be only about a year or so. For self-storage, maybe a couple of months, although sometimes it can be longer. But then, there are REITs on the other end of that spectrum that have quite lengthy lease durations. And the point of showing you these data is to demonstrate that in periods of rising economic growth, we do want to look carefully at lease duration, because the faster a landlord can reprice its rents to current market conditions, the better able it will be to collect higher rents and ultimately grow their earnings and cash flows. And so we, in the current environment, have started to orient our portfolio toward some of those shorter lease duration property types. So we have an overweight in hotels, we have an overweight in self-storage, we're getting more aggressive in our apartment allocation. All of those property types are ones whose lease durations tend to be on the short side. I'll skip a few slides here and just show you the data on this slide to talk about the very significant dispersion in performance across property types. This is a very diverse asset class. You've got property types that span a lot of different sectors. in the commercial real estate world, and the performance, the REIT performance of those sectors can differ quite meaningfully depending on which sectors are in favor and which sectors are out of favor. Just to give you a recent example, if you look at this chart here and you look at the data in 2020, I mentioned before, REITs as an asset class were down 5% in 2020, but realize that 5% decline masks a whole lot of volatility at the sector level. So you had property types like data centers doing quite well. Data centers were up 21% last year, even as REITs as an asset class were down 5%. Fortunately for us, we were overweight data centers last year, and it contributed meaningfully to our outperformance. Whereas if you look at the bottom of that chart, you'll see that in 2020, the worst performing property type was regional malls, down 37% for reasons you can probably suspect. You know, the challenges of social distancing, the shutdowns that we saw early in 2020 all contributed to a very difficult time for lots of retail landlords. So this dispersion, it's not unique to 2020. As you can see, you can take almost any calendar year at random and observe massive dispersion across property types. And it's, of course, the job of active managers such as us to understand which property types are in favor and which are not, and allocate accordingly. And the point is that active management can add substantially to total return in a REIT strategy such as ours because of the ability to take advantage of those mispricings. I'll skip a few slides here and talk about our current market positioning. This is for our flagship Realty Shares Fund. This is the fund that just celebrated its 30th anniversary. So it's our oldest fund and most representative of what we do as a firm. These numbers are as of June 30th. So they're a little stale, but they're still pretty much in line with our current positioning. So this is a good instructive slide to review. So I'll make a few comments here about the various property types that we've allocated to. I might start at the bottom of this table. You'll see that office REITs represent only about 1% or so of the total fund. And relative to our index, where office has about a 7% allocation, it is our largest sector underweight at the moment. And it's probably evident, or at least some of the reasons why we're so underweight office are probably evident to most of you. But I should say that, you know, we entered 2020 before COVID was on anyone's mind. We entered 2020 underweight office, not quite as underweight as we are right now, but still underweight. And at the time, the thinking was, you know, we've got a lot of new supply. There's been a lot of new development of office properties in places like New York. You know, you've got, of course, the new World Trade Center downtown. You've got the Hudson Yards development on the west side. That's millions of square feet of office space to contend with. You've also got landlords spending more to make their properties more amenable to the co-working model that had emerged over the last few years, things like WeWork and the like. And so the combination of a lot of new supply with greater expenses had made us cautious on office. You throw COVID into the mix and the whole work from home environment that has persisted and may persist indefinitely, if not forever. And that's a real challenge. And we have had a hard time underwriting a favorable environment for most coastal office landlords that own assets in places like New York or Los Angeles or San Francisco. And so where we see any opportunity in office is really in the Sun Belt of the US, places like Charlotte, North Carolina, or Tampa, Florida, or Nashville, places where you haven't seen the same plunge in occupancies and where job growth is likely to be particularly strong in the short term. So that 1% allocation represents a Sunbelt office landlord that we like. When you look at retail, you can see that shopping center REITs represent only about 2 or 3% of the total fund. And we are underweight shopping center REITs. And we've been long of the opinion that retail landlords will face significant challenges from e-commerce. Shopping centers are at the heart of that, as are regional malls. Now, regional malls do bear some explanation here. You'll see that regional malls are close to 6% of the fund, and they are overweight relative to our index. This is just one company. That 5.78% is only in Simon Property Group, which is a world-class mall landlord. And the reason it is world-class is because it has, in our opinion, the right combination of access to capital, very strong balance sheet, and management skill to repurpose a lot of their mall assets away from that department store anchor model that is fast being eaten up by e-commerce. The apparel-based model is really all going online. And what Simon is able to do, because of their access to capital and skill at doing this sort of thing, is repurpose their assets away from that model of yesteryear and toward a more mixed use model. Things like restaurants, dining out, movie theaters, entertainment centers, fitness centers, the kinds of things that are just naturally less of a threat from an e-commerce perspective. That is a very capital intensive exercise, though, to knock down, department store anchor locations and turn them into something more appealing. And most mall landlords don't have the same kind of balance sheet to be able to do that. So it's a very narrow universe of retail landlords that can do that. Simon, in our opinion, is the one that can, which is why we own it in the portfolio. I'd also point to the overweights that we have to some of those shorter lease duration property types, things like self-storage, things like hotels. Those are on the shorter end of the lease duration spectrum. You'll see that storage is our largest overweight. It is enjoying some of the strongest fundamentals that we've ever seen for this property type. We started to see demand for storage spike really last year as we saw a lot of relocation activity. People were, and still are, reconfiguring their personal space to accommodate a work from home environment that is likely to persist. And all of that, and now the economic growth that we've started to see is likely to be supportive eventually of new household formation as younger people get jobs and move out of their parents' homes and form new households. There's a very high correlation between household formation and demand for storage. And so the rents that these storage companies are charging continue to go up. And so their earnings and cash flows continue to go up. And fortunately, their share prices continue to go up. And we think that this is a trend that that does have legs. So I might also refer, before I turn it back to Mark, we do have a position in data centers, as you can see, about 9.5% of the portfolio. It is about in line with the index weight. That just reflects the fact that they've done so well. And from a relative value standpoint, they're less attractive than other property types are. And then finally, what you see listed here as infrastructure, that 16.24% allocation, is really just the cell tower REIT market. That is how our index provider classifies cell towers, as infrastructure. But so 16% of the fund right now is in the cell tower REIT market. Again, that's one of the property types most leveraged to changes in technology and changes in the way that consumers and corporations engage with that technology. But I thought I might stop here. Maybe, Mark, I'll turn it back to you and open up the floor to some questions, and happy to answer any questions that anyone has.
Okay, thank you so much, Evan. That was terrific. So we're going to open this up to questions. Mary Harris has been working her Zoom magic in the background and putting everybody in a position where they can turn on your microphone and your camera if you like. If you've managed to shave and put on a shirt today, we'd love to see you. So you just have to click on your video and click on your audio, and you can ask a question. And Evan, if you could stop sharing your,
Sure.
and then we can see everybody.
Okay. I have stopped.
Okay. And the only person, Herb, I don't know if we're going to be able to hear you or not for some reason. You can always text me, and it's probably good since you're somebody who knows me well. You might say something that would embarrass me anyway, so you can text me. Oh, they can't turn on the cameras? Oh, I'm told nobody can turn on the cameras, but I see Richard, you have your hand up, Dick?
Yeah, this was a terrific presentation, by the way, and very informative. I'm curious to know whether or not in any of your funds, a company like Annaly has any relevance.
Yeah, they're more on the mortgage side.
Right.
So and I should say there are REITs, publicly traded REITs, investable REITs that don't own commercial real estate properties, but own mortgages and provide financing for commercial real estate owners. So our mandate has always been to own what are known as equity REITs. These are the companies that own and operate the assets themselves. So no, we don't own Annaly in our portfolios.
Okay.
Anybody else want to ask a question? You can just jump in.
How do you feel the tapering that's going to happen within the next 2 to 3 months is going to affect the overall market as well as the REIT market?
Yeah, well, it's not fully a surprise because we've seen pretty sharp economic growth since the depths of the pandemic, and we have always been of the mantra, and it is borne out by the data, that it's not so much rising interest rates or rising rates at all, so much as it is rising rents. And if the Fed is choosing to taper because they're seeing evidence of accelerating economic growth and want to ensure that it doesn't overheat, that's normally a good environment to be in if you're a commercial real estate landlord, because that means that that you're likely to see greater demand for your assets than you would if economic growth were middling. And it's also the case, and here's another piece of conventional wisdom that I think we try to dispel a lot, is that REITs, because they pay a healthy dividend yield, are proxies for fixed income or proxies for bonds. And the reality is something very different. And while you may see some short-term volatility in REIT shares when rates start to spike, the reality is that REITs are not fixed income, at least the kinds of REITs that we're investing in this portfolio, because the income that REITs generate via the dividends that they pay out are quite variable. They can keep rising and rising and rising if landlords can continue to collect higher and higher rents. So there can be a virtuous cycle of dividend growth that is very different from what you get in the fixed income market. So to the extent that the Fed has decided to start tapering soon, we would welcome it so long as it's an indication that economic growth is strong and therefore demand for commercial real estate is strong. I'd make one other point about that too, in terms of just general financing. REITs as an asset class, the kinds of REITs that we're looking at, the equity REITs, are very well capitalized, and that is really owed to the work that REIT management teams have done over the last really 15 or so years since the financial crisis, of selling off non-core assets, issuing equity, shoring up their balance sheets, demonstrating to the marketplace that their liabilities are not likely to overwhelm them at all. And so loan to value ratios have come down meaningfully for these companies, which also should mitigate any stress over any kind of taper tantrum that we're likely to see.
Thank you. And by the way, it is a beautiful presentation.
Thank you very much.
I'm going to say something and ask a question of you, Evan, and I may be throwing you a little bit of curve here. So just some background. So in 2020, early that year before COVID, we had a global realty fund with
Mhm.
you guys.
Okay.
And in April, we had a meeting amongst ourselves whether we were going to stay with real estate or not. At
Mhm.
that point, real estate was down about 35%. And we elected to stay, but we changed to the domestic real estate fund, the one we're in now,
Mhm.
which now, as of the end of the year, our typical client was off 3 to 5% in 2020, and they're up about 27% year to date. So number one, we in this Realty Shares, I think the name of it is, that's 100% domestic, if I'm not mistaken.
It is. Now, the Cohen & Steers Realty Shares is 100% domestic. Cohen & Steers Global Realty Shares, of course, is global. That may be the fund that you were in previously.
Yes, yes.
Okay.
But so in that same vein, there's a little bit of bubbling going around about Evergrande.
Yes.
And, we're not presumably directly exposed to that, but is that something that we should be concerned about?
Well, it's a question I have fielded probably a dozen times in the last week from different clients and advisors. The short of it is Evergrande, for those of you who may not know, is a publicly traded developer of residential properties in mainland China. They're listed on the Hong Kong exchange, but they're effectively a Chinese company. And what's going on with Evergrande is that their liabilities have now risen to the hundreds of billions of dollars, and now there is a real threat of their continued solvency. What I will say about we've not owned Evergrande in the global fund. I don't believe we've ever owned it, and we certainly don't own it now. And Evergrande is a bit unique in that there are other developers, publicly traded residential developers in mainland China, who don't have nearly the same liability burden. But even in the Global Realty Shares Fund, we do not own any Chinese developers. We own about 5% in Hong Kong, but those Hong Kong companies are much more domestically oriented. The base case for Evergrande at this point, as we see it, is that the Chinese government is likely to step in and cancel out all the equity, most of the debt probably, and force other developers to take on the assets. So we don't anticipate a contagion effect because the balance sheets of the other publicly traded development companies in China are not nearly as bad. So it's not likely to be an issue that, certainly for the companies in the domestic fund will be material, or even for our allocation in Hong Kong.
Good. Hopefully I didn't get everybody nervous, and I didn't expect that we would have any reverberations on that, but it is a topic that's bubbling up in the news over the last week.
Yes.
And we watch this stuff.
Of course.
I don't know, Dan or Tim, if you have anything you want to add or ask. Okay. I think unless somebody else has something, did I hear somebody start to say something? No. Okay.
Hey, Mark. Here
yeah.
Jack Sheehan.
Okay, Jack.
Yeah, Mark. Thanks very much, and Evan, thanks so much for your preparation for your presentation here. It's been very informative, and Mark is more known for throwing the high inside fastball to his clients, and I'm disappointed that all he had for you was a curveball. So I'm just going to kind of lob one over the plate for you,
Okay.
To keep up with the analogies. What are your thoughts on the workplace changing in sort of the work culture as it has adapted to the COVID pandemic?
Yeah.
And what are your thoughts on what the return might look like that could affect that could affect REITs?
Right. Well, we anticipate the office REIT sector is really the one sector where we are anticipating some sort of permanent demand destruction as a result of what we've been through. Now that will be different in different parts of the US. It will even be different in different parts of the world. In our global realty shares, for example, we've started to get a little more positive on office REITs in places like Japan and Singapore, because there isn't the same impetus to remain working remotely forever that there seems to be in lots of the US. So it's going to differ by region and by country, but it's fair to say, just speaking domestically for now, that the demand destruction will probably range anywhere from 5 to 15%. And so what you have to balance that with is the reality that as people return to office, there is going to be a reversal of a trend that we've seen over the last few years. And this is what had kept us cautious on office even before COVID, of densification. Over the last few years, up to the point of COVID, we had seen office tenants densify their space just by squeezing more people into the same amount of square footage, just to be more economical about things. That is going to have to reverse one way or another as people return to office life. There's going to be a need, an obvious need to keep people physically apart, and that's going to result in some sort of reversal of densification. And all things being equal, that's a good thing if you're a landlord. But you have to weigh that against that permanent demand destruction that I described earlier. And when you weigh the two, the demand destruction is probably going to win out. And so that is really informing right now how we go about looking at office landlords. Office landlords were large underperformers last year. And you would think that, well, now we're in a better environment, people are starting to get back to office life. There may be some opportunities there. It's hard for us to underwrite a favorable valuation for many of these companies because the leasing, the future leasing activity is so uncertain. Right now, and even through much of last year, the tenants were paying their rents. The rental collections were stellar. Well north of 95% of what you would expect to collect. That's not the issue. The issue is what is future, all of those leases that are coming to maturity in the next few years, are they going to be renewed? Or are tenants going to say, look, we don't need this much space, we can do with a lot less? And so that's, no doubt, people will return to the office even as a firm. I'm not in the office right now, as you can plainly see, but I've been back to our headquarters in Midtown Manhattan a bunch of times already. So people are starting to go back. The question is, what is that future leasing activity going to be? In an environment where economic growth is starting to turn healthy after a recessionary environment, we'd probably, under a normal recovery, a non-COVID recovery, we'd probably have better visibility into that. We don't right now. And that's what's making it challenging to get more positive on office, despite the better economic environment that we're in.
Okay, Jack.
Thanks, Evan. Thank you.
Sure.
Jerry, were you going to say something?
No, I didn't have any questions.
Okay. Well, I think that's it then. Thank you, everybody, for joining us. I hope the next time we can buy everybody dinner at a restaurant, which would be a lot more fun, and maybe I can tell a bad joke or two. But thank you, Evan, and I see Damien on the call as well. Thank you, Damien. And we're going to sign off. Thanks, everybody.
Thanks, everyone. Take care.
Thank you, Mark and team. Thank you all.
Thank
Have a
you.
good night, everybody.